The secret to making money on the share market, that was a dramatic pause.
We have built one of the best retail platforms in Australia for Australian investors in the country, with our members now getting 3 amazing services in one place, including InvestSMART's free portfolio services, Intelligent Investors Equity Research, and Eureka Report's broad wealth commentary.
We've outperformed the market for 15 years now, and we've done that consistently and by quite a large margin.
Hello, I'm Tony Kaye, the editor of Eureka Report. Welcome to the Economic View. I'm joined by Callam Pickering, our economics writer.
Great to be here.
Welcome, Callam. Callam, I wanted to talk about the budget. We've got some very optimistic forecasts in there in regards to getting back into surplus. So we're going from, according to the government anyway, we're going from 37 odd billion or nearly 38 billion down to a surplus in only a few years, really. How are they going to do it? Is it achievable?
Well, in short, probably not. Now, the forecasts contained in the federal budget are extremely optimistic, heroic even, and look, that's been the case for a number of years now, where the government's always promised that a surplus is just around the corner and then it inevitably gets delayed again and again. Now, the federal government's expecting a budget deficit of 29 billion in 2017-18, down to 21 billion in 2018-19, and then we get to surplus by 2021, where it's a modest surplus of about 7 billion. Yeah. Now, this is being achieved through quite strong economic growth. So the budget is assuming the growth gets to 3% and remains there indefinitely. Now, that doesn't necessarily seem unreasonable by historical standards, but over the past decade, the Australian economy has grown by around 2.6% year after year. And that's where most experts expect that the economy can grow at a sustainable pace. 2.6, 2.7%. 3% is a little bit stronger than that. So that's probably the first red flag that we have. The other major issue relates to wage growth. Now, currently wages are increasing at 1.9% over the year. That's the weakest level in about a quarter century, so since our last recession. Yeah. Now, the budget assumes that wage growth is going to pick up steadily from this point, and it's going to increase to 3.75% by 2021. Now, that's extremely strong growth and probably unrealistic given where the Australian economy is and where it's expected to be over the next few years.
Yeah, I mean, wage growth has been static for so long. You know, what's going to be the real pickup in wages growth?
That's the key question, and it's really hard to see why wages are going to bounce back, particularly as rapidly as the federal government expects. One of the problems is the unemployment rate. It's currently at 5.9%. Now, in order to get wage growth up to 3.25%, you would expect the unemployment rate to decline down to 4.5%, maybe even a little bit lower over the forecast horizon. The problem in the budget is that the federal government is assuming that the unemployment rate gets down to 5.2%, I think it is, which is nowhere near low enough to get that sort of wage growth. If the unemployment rate fell to 5.2%, you'd expect wages to maybe increase towards 2.5%, which is still weak by historical standards, but would still mark a significant improvement on where we are right now. The problem is, if wages were to grow at 2.5% rather than 3.75%, we're not getting anywhere near a surplus.
And I suppose the other big factors for Australia are we need commodity prices to keep rising, which they're not. They're dropping. So that's obviously going to impact on the mining sector further, on investment in the mining sector over time. Then the government's put in all of these initiatives around infrastructure spending. Now, they're obviously going to drive some jobs in the economy, but it's going to be fairly narrow overall, I would expect. So, it's a bit hard to know how these numbers are all really adding up.
Yeah, there's a few things going on with regards to the labour market that are going to be interesting to keep a track of. As you said, with regards to the federal government's infrastructure program, that does have the potential to create jobs, though the program itself isn't really huge. It's not going to be a key driver of jobs, but it will help to some extent. But to some extent, it's going to be offset a little bit by the mining investment story, which still has probably a good 12 to 18 months to run, and that is going to hurt jobs in that sector. Commodity exports are very strong, but they don't generally drive jobs. That's more capital intensive rather than labour intensive. So you sell more iron ore, you're not necessarily employing more people than you were if you were selling less iron ore. And there's a few other things that are going on. The end of the motor vehicle industry, for example, is going to hurt jobs in that sector and related sectors as well. And of course, residential construction appears as though it's going to be at least near its peak. If it hasn't already peaked, it's likely to happen in the next 3 to 6 months.
And then you've got what's happening in the retail sector.
That's right, and retail conditions have been quite weak and do appear to be easing somewhat over the past 6 months or so. So you could see some muted employment growth in that sector as well.
All right, Callam, no, that's good. I mean, we're really going to have to see how these numbers pan out. As with every budget, the surplus number at the end of the rainbow seems to move around a fair bit, so we'll have to see where we are this time next year.
Yep.
Thanks for joining us. I'm Tony Kaye. I'm the editor of Eureka Report.